Okay, so there's a massive shift happening right now on Wall Street. It's arguably the most definitive move yet regarding digital assets.
It really is.
This isn't just, some tentative trial or a footnote in a research paper. We are talking about a formal structural policy change from Morgan Stanley.
Yeah, one of the titans.
Exactly, one of the bedrock institutions of global finance. And it signals that the institutional floodgates, well, they're not just open anymore. They're actually being formalized. That's the word right there, formalized.
Yeah.
What we're looking at today, really, is a critical piece of normalization. Morgan Stanley has officially set a ceiling.
Ceiling, okay, yeah.
On crypto exposure, but specifically within its most aggressive wealth management strategies, they've landed on a specific figure, 4%.
4%?
A 4% allocation cap for digital assets inside their opportunistic portfolios.
And this feels like more than just a number, right? This 4%. It signals that crypto is maybe moving from just being a speculative curiosity to becoming a defined, maybe even necessary piece of the institutional investment framework. Exactly. And the real story here, I think, is the convergence you mentioned. Morgan Stanley isn't just pulling this number out of thin air.
Right.
They're formally aligning themselves with other giants who've been, sort of pioneering this institutional crypto exposure, thinking specifically of BlackRock and Grayscale.
So this emerging institutional consensus, that's like the ultimate stamp of approval.
It has to be. I mean, when the biggest asset managers in the world start agreeing on a specific level of exposure like this, well, that whole Wild West narrative around crypto, it kind of fundamentally collapses, doesn't it? It really does. So our mission in this deep dive today is to pull apart the sources, break down 3 core questions for you first. What's the practical reality of this 4% allocation?
Yeah.
How do professional portfolio managers actually implement it? What does it mean for risk? Second, why is this formal standard happening right now? The timing, yeah. Exactly, at this very moment in market history. And maybe the most compelling question, how will this formal consensus-driven policy reshape the entire crypto investment landscape? From Wall Street all the way down to, say, the Web3 developer building the next big dApp. It's truly a seismic shift. I mean, think about it. When a financial titan, the scale of Morgan Stanley, integrates digital assets into its core structure, it tells the entire market that, okay, big money is permanently establishing its space in this ecosystem. They aren't just reacting to client demand anymore.
They're setting the standard.
They are setting the long-term industry standard.
Okay, let's start by defining the details.
Right.
This standard. Morgan Stanley has imposed a hard limit on crypto exposure.
4%.
4%. And it's explicitly placed within its opportunistic portfolios. Can you maybe clarify for our listeners what exactly an opportunistic portfolio means in this context?
Sure. Yeah, that's important. So these are investment strategies, right? They're specifically structured for, let's say, sophisticated investors, people chasing high growth, maximum returns.
Okay. Higher risk appetite.
Definitely higher risk appetite. Managers running these portfolios, they have more latitude. They can invest in assets that are considered, highly volatile or unconventional.
Like what?
Things like venture capital funds, maybe distressed debt, or even highly specialized commodities futures. The main goal is just maximizing returns, and you accept higher risk for that potential. Well, what they call asymmetric upside.
Asymmetric upside, meaning the potential gains are way bigger than the potential losses.
Potentially, yeah. That's the hope. So putting crypto here, well, it makes sense, given its volatility.
In a way, placing crypto in that high-risk bucket makes sense. But it's the imposition of the limit that seems really significant here. Why 4% specifically?
Well, the 4% is designed as a controlled ceiling, right? The idea is to maximize the potential return contribution from crypto, while preventing that volatile asset from just completely overwhelming the returns you're getting from the more stable parts of the portfolio, like equities and fixed income.
Got it. Control the blast radius, so to speak.
Something like that, yeah. And this figure, 4%, it's significant because, like you said earlier, it's not an outlier. It actually mirrors almost perfectly the models already being pushed by BlackRock's private wealth advisory arm. And also the institutional strategies that Grayscale has been recommending.
So BlackRock and Grayscale, they've generally been guiding clients towards something like, what, 3 to 5% allocation?
That's the range, yeah, 3 to 5%.
So when Morgan Stanley comes in and anchors itself precisely at 4%, it doesn't just confirm that range. It feels like it's effectively establishing a new Wall Street benchmark. Like, this is what responsible, risk-adjusted crypto exposure looks like now.
Exactly. That's precisely it. For institutional investment, consensus equals legitimacy. Think about it.
Yeah.
If one big firm says 10% and another says 1%, well, the asset is still kind of contested, right?
Yep.
Yeah, nobody knows what to do. Right. But when the three largest voices, arguably, in wealth management and asset control, all basically agree that 4% is the sweet spot. That tells every other financial institution, okay, this is the scientifically verified appropriate level of risk for a sophisticated, a diversified portfolio.
Let's think about the implications of that. A major bank formalizing crypto into these structured long-term models. This really moves the asset class past just temporary speculation, doesn't it? Feels more like structural permanence.
It absolutely confirms permanence. And, it also dictates future competitive strategy. History shows us a pretty clear pattern here.
Okay.
When one financial leader sets a precedent like this, especially one that aligns so neatly with BlackRock's massive ETF success, well, competitors basically have to follow.
Or risk looking like they're behind the times.
Precisely. So we should fully anticipate seeing similar 3 to 5% allocations emerging pretty swiftly from the competing banks, Goldman Sachs, JP Morgan Chase, Fidelity, in their structured wealth offerings.
Because failure to do so would quickly look like they're offering an inferior product, maybe.
Exactly. It becomes a competitive disadvantage not to offer it.
So Morgan Stanley isn't just like trying to get ahead of the curve here. They're actively kind of dictating the new institutional playbook. But does this put pressure on financial advisors? Do they now have to sort of sell this idea to clients who might be naturally risk averse?
Oh, it absolutely changes the conversation for advisors. The bank is basically creating the structural space for digital assets now. So for clients with managed portfolios, crypto exposure, it's shifting from being, an optional conversation and opt-in to becoming a standard line item on their annual statement. It's an expected part of their risk-adjusted model.
Wow.
So the advisor's job shifts. It's less about convincing the client to maybe explore crypto and more about explaining why this specific controlled 4% allocation is, well, mathematically necessary for optimal performance according to the bank's models.
That changes the whole tone of wealth management, really.
Completely.
Okay, so the next obvious question is timing. Why this moment? Why is this 4% cap being formalized now? Why not back during the, peak euphoria of the 2021 bull run?
Right.
This move clearly lines up with a historic crypto market rally, yes, but maybe more importantly, with these unprecedented ETF inflows we've seen.
Yeah, I think the catalyst is the ETF effect. Pure and simple. The launch of those spot Bitcoin ETFs earlier this year, led by BlackRock, Fidelity, and others, that basically solved the big institutional problems.
Which were?
Custody, compliance, accessibility. These regulated vehicles, they brought billions in capital from traditionally conservative pools of money straight into the ecosystem.
Instantly.
Almost instantly. And that just solidified crypto as a core investable alternative asset class. But crucially, one that's accessible through familiar Wall Street structures.
And we have a pretty staggering example of that impact, right? BlackRock's iShares Bitcoin Trust, IBEAT.
Incredible story.
In less than a year, it's accumulated and now manages over, $20 billion in assets.
Yeah. $20 billion. That record-breaking speed of capital deployment, that's like an institutional siren call. You just can't ignore it.
It really feels like the defining factor.
I think it is. The speed, the magnitude of that institutional participation, $20 billion in under 12 months. That signals the asset class has really transitioned. It's out of that initial kind of experimental phase and into more mature, regulated territory. So for a bank like Morgan Stanley, formalizing exposure isn't just about future strategy anymore. It's become a competitive necessity, maybe even a fiduciary one.
How so?
Well, if their main competitors are offering clients access to an asset generating these kinds of inflows, Morgan Stanley has to either match that or exceed it somehow. Otherwise, they risk losing client trust and their competitive edge.
Makes sense. Beyond just the ETF mechanism, though, are there other sort of objective market indicators confirming this idea of maturity? Enough to justify banks making such a permanent structural commitment? Yeah, definitely. We can look at, say, 3 key quantitative indicators that show the market is ready for this kind of formal integration. First, volatility.
Okay, it's dropped significantly compared to previous cycles. It's moving closer to the volatility profile you might see in high-growth tech stocks rather than purely speculative penny stocks.
So still volatile, but less wildly so.
Liquidity is way up dramatically.
Yeah.
That means institutions can execute massive buy and sell orders without causing those crazy cascading price swings we saw back in 2017 or even 2021.
Yeah.
The market can absorb large trades better.
Okay, stability.
Yeah.
More stability, deeper order books. And third, on-chain data. If you look at blockchain data, it confirms pretty robust and persistent institutional accumulation patterns. So big players are buying and holding.
Yeah, showing HO dealing behavior, not just quick speculation. All these factors together signal that the asset itself is behaving in a more stable, predictable, and frankly, institutionally palatable way. And that justifies this formal 4% adoption.
It sounds like the environment has finally been, I don't know, scrubbed clean enough for the big money to feel safe coming into the room.
That's a good way to put it, precisely.
Yeah.
They basically waited until the regulatory uncertainty started to decrease, and the market infrastructure, things like custody solutions, prime brokers, regulated exchange products, was robust enough to handle their scale.
Plumbing had to be ready.
The plumbing had to be ready for institutional size.
Okay, let's drill down into the financial science behind the number itself. Why exactly 4%? This figure must be rooted in something more rigorous than just, a gut feeling.
Oh, absolutely. It's anchored squarely in modern portfolio theory.
MPT.
MPT. Yeah, MPT is basically the foundational framework for institutional asset allocation. The theory, pioneered by Harry Markowitz back in the day, it aims to select investments that maximize your expected return for a given amount of market risk.
Or minimized risk for a target return.
Exactly, the flip side. So this 4% cap, it's the mathematical sweet spot they've identified. It balances crypto's inherent volatility with its potential for that asymmetric upside we talked about.
Can you elaborate a bit more on asymmetric upside in this MPT context?
Sure. It basically means the potential reward is disproportionately larger than the risk you're taking on. Crypto, especially Bitcoin and Ethereum, has historically shown quite limited correlation with traditional assets.
Like stocks and bonds.
Like the S&P 500 or U.S. Treasury
right.
bonds, yeah. So in MPT terms, adding a small amount of an uncorrelated or low correlation asset to a portfolio actually increases diversification.
Even if that asset is volatile itself.
Even if it's volatile, the volatility of that small crypto portion gets counterbalanced mathematically by its non-correlation with the larger equity and bond parts of the portfolio. History shows, through allocation studies, that putting that 1% to 5% sliver into a high-growth, uncorrelated asset, it dramatically pushes the portfolio's efficient frontier outward, meaning you can potentially get better overall returns without drastically increasing the overall risk profile of the entire portfolio.
Interesting. So the argument isn't really that crypto reduces risk overall.
No, not directly.
But that it adds a potentially huge return component without adding systemic risk to the rest of the portfolio structure because it behaves differently.
That's it, exactly. And in today's market environment, where traditional fixed income bonds is really struggling to provide that diversification buffer during equity downturns.
Yeah, correlations have been weird.
They have. So the search for genuinely uncorrelated assets is pretty desperate. Crypto fits that bill nicely. So this 4% allocation, it's viewed as kind of the optimal hedge.
What happens if you go too low or too high?
Well, if you allocate too low, say less than 1%, the asset's performance is basically negligible to the overall portfolio return. It doesn't move the needle. If you go much higher than, say, 5%, then the volatility of that crypto component starts to really dominate the portfolio's overall risk. It makes the whole thing potentially unstable.
So 4% is that scientifically optimized point for getting the maximum diversification benefit without taking on too much concentrated risk from crypto itself.
That's the rationale based on MPT modeling, yes.
Okay, now here's where the sheer scale of this move becomes really apparent. Let's talk about that dramatic calculation cited in our source material.
Yeah.
If we assume the whole industry basically follows this 4% standard,
Yeah.
what are we actually talking about in terms of capital commitment?
Yeah, the numbers here are genuinely staggering. If we look specifically at just the top 10 U.S. wealth managers, the big banks and asset managers like Morgan Stanley, BlackRock, and their peers, their estimated total assets under management, AUM, is somewhere around $50 trillion, give or take.
$50 trillion.
Now, just apply that modest-sounding 4% allocation cap to that total pool of managed assets.
4% of 50 trillion.
Yeah.
My math isn't great, but that's $2 trillion?
$2 trillion.
Wow.
Yeah. Let that number sink in for a second. It's $2 trillion. And remember, that's just from the top 10 wealth managers in the U.S. alone.
Right. Does include global markets, pensions, smaller advisors.
Exactly. All of whom will likely follow suit eventually. Now, compare that potential $2 trillion inflow to the current overall crypto market capitalization. Estimates suggest that influx alone, it has the potential to effectively double the entire crypto market cap.
Double it.
Potentially, yeah, within a single macro cycle. That's the kind of impact we're talking about.
Okay, but let me push back a little here. A critical question arises. If $2 trillion of institutional money suddenly floods into a market that, let's face it, has historically been driven largely by retail liquidity,
Yeah.
does that huge capital influx truly stabilize the market in the long run? Or does it just inflate prices dramatically in the short term without necessarily stabilizing the underlying utility or increasing fundamental value?
That's a necessary and really important critical challenge. And the answer is probably both, to some extent. In the short term, yes, absolutely. Such a massive, rapid influx would almost certainly cause significant, potentially inflationary price increases. We saw a glimpse of that with the initial ETF launches.
Right.
However, the way this institutional money enters is different from previous retail-driven booms. This capital comes in through structured long-term products, the ETFs, trusts, maybe tokenized funds down the line.
And it's managed differently.
It's governed by strict rebalancing rules dictated by that modern portfolio theory we discussed. This institutional capital is inherently more stable, it's stickier than retail speculation.
Why is that?
Because it seeks long-term return and diversification benefits, not quick flips. So while prices will likely inflate initially, the liquidity provided by these institutions also deepens the market significantly over time. That gradually stabilizes the market structure as a whole. The money coming in is quote-unquote smart money, following a defined long-term strategy. And that fundamentally changes the risk profile of the asset class.
So less likely to panic sell at the first sign of trouble.
Much less likely. It's allocated based on models, not emotion.
Okay, let's talk about that convergence again. It seems key here. What we could maybe call the triangle of consensus. Morgan Stanley, BlackRock, Grayscale. They now share essentially identical allocation strategies. This doesn't feel like fierce competition on this point. It signals more like a shared recognition of, well, the new normal.
Yeah, institutional normalization is a good term for it. They're basically teaching the entire financial industry how to treat digital assets now. Not as some fringe experiment anymore, but as a small yet essential piece of your alternative exposure. It's being slotted right alongside things like high-yield real estate, maybe gold, private equity, all within that modern portfolio construction framework.
So it's just another box to tick in a diversified portfolio.
Becoming that, yes.
Okay, once this standard is set by these, titans of finance, where does the cascade effect take this 4% rule next? Where does it filter down to?
Well, the cascade is probably already underway, and it's fairly predictable. First, you'll see it filter down to the independent financial advisory platforms. They now kind of have to include this allocation to demonstrate prudence and keep up.
Right, they follow the big guys.
Then, next, expect accelerated momentum for its inclusion in 401k retirement offerings. That's a huge pool of capital, inherently long-term focused.
That would be massive.
Huge. And finally, it basically becomes mandatory, or at least heavily recommended, in private wealth portfolios, especially those aimed at generational wealth preservation and growth. The 4% exposure just becomes the baseline standard for what's considered acceptable risk-adjusted returns.
To really grasp the magnitude of this psychological shift, it might be worth revisiting the story of BlackRock CEO Larry Fink. It really underscores the incredible U-turn that was required from institutional leadership.
Fink's journey is the perfect encapsulation of TradFi's change of heart. You remember, right? It wasn't that long ago.
Yeah, he was very dismissive.
Very dismissive. Larry Fink publicly called Bitcoin, I think, an index of money laundering, or maybe just outright a fraud.
I could like that,
today. Yeah. He's arguably the most vocal champion of Bitcoin adoption out there, overseeing the launch and, frankly, the stunning success of their IBIT ETF.
It's quite the turnaround.
It's not just a business decision. It feels like a profound psychological capitulation. For a CEO of his stature to make such a public 180-degree reversal, it just demonstrates that the evidence, the massive inflows, the growing stability, the undeniable client demand, it all became impossible to ignore.
Forcing a complete shift in the institutional narrative and maybe even his personal conviction.
It certainly seems that way. It speaks volumes about how irrefutable the data must have become for him to change his stance so completely.
And presumably that same pressure, that same data, drove Grayscale's strategic pivot, too.
Absolutely. Grayscale initially dominated the space with its GBTC trust, but that was primarily a retail-focused vehicle known for those sometimes crazy high premiums and then deep discounts.
Right, the NAV spread.
Exactly. Now, they've fully embraced the ETF structure. They're focusing intensely on institutional compliance, custody solutions, transparency. That transition from a high premium retail product to a regulated institutional grade vehicle, that's what makes their offerings palatable for use by banks like Morgan Stanley in these new models.
And let's widen the historical lens a bit. This isn't happening totally in isolation, right? Others have been talking about this for a while.
No, not at all. Firms like ARK Invest, led by Cathie Wood, they're recommending a 2 to 5% allocation in their growth portfolios as early as 2021.
Ahead of the curve there.
Definitely. And meanwhile, you have other giants like Citi and JP Morgan. They're not just sitting back watching. They're actively working on the underlying plumbing.
Like what?
Exploring blockchain technology for things like tokenized deposits, looking into various deep DeFi integrations. So this 4% consensus we're seeing, it's really just the public, visible tip of a much deeper, coordinated, multi-front advance by traditional finance into the digital asset space.
Okay, so when traditional finance embraces crypto in this very formalized way, what are the tangible positive consequences? Thinking about, say, the average retail investor just managing their personal savings, and also for the core Web3 ecosystem itself.
Well, the benefits are pretty substantial, and they're multifaceted. For the market overall, this institutional embrace brings significantly increased liquidity, much greater transaction depth. That makes the market far more resilient to sudden shocks.
More stability again.
More stability. And crucially, it imbues the whole asset class with undeniable long-term legitimacy. And hopefully, that leads to greater regulatory clarity down the road. For the retail investor specifically, they benefit almost immediately from the superior institutional infrastructure that inevitably trickles down.
Oh, so?
Things like better trading execution, potentially lower fees just due to economies of scale, and definitely broader accessibility through platforms they already use and trust.
And we're already seeing that accessibility piece manifest, aren't we? Big players like Fidelity, Schwab, they seem to be rapidly expanding their crypto trading and custody services for their general retail customers.
They have to. It makes perfect sense. The sophisticated systems built to service that potential $2 trillion in institutional money, they inevitably enhance the experience for the consumer too. It lifts all boats.
Okay. And what about the underlying Web3 projects, the dApps, the protocols? How do they benefit?
They gain immense credibility, even if it's indirect. And potential future funding improves. While that new $2 trillion isn't likely going directly into, some small community token tomorrow,
Right.
The overall legitimacy boost and the increase in the baseline valuation of the entire ecosystem. That means more venture capital becomes interested, more talented developers are attracted to the space, and just more traditional business interest flows towards the underlying decentralized technology itself.
But you mentioned earlier something about an institutional bottleneck. Where is this $2 trillion likely to prioritize its entry right now? What does that mean for, say, altcoins or smaller projects?
Yeah, the bottleneck is a really defining characteristic of this current institutional phase. They prioritize what's regulated, what's established, and what has extremely high liquidity, first and foremost.
So, Bitcoin and Ethereum?
Overwhelmingly, yes. The evidence is crystal clear in the flows we've seen. The inflows have gone almost exclusively into Bitcoin ETFs and, to a lesser extent, regulated Ethereum trusts or futures products. Institutions tend to view Bitcoin as digital gold, a store of value.
Okay.
And they see Ethereum as maybe the global computing platform or digital oil. Altcoins, smaller tokens, early-stage DeFi protocols, they generally lag behind in this phase. They remain highly speculative in institutional eyes because they often lack the regulatory clarity and, crucially, the liquidity scale that institutional trading desks require.
So BTC and ETH basically serve as the secure, familiar on-ramp for these institutions.
Exactly. They establish the initial comfort level. However, and this is important, this comfort level tends to initiate what you might call the second wave effect.
Okay, what's that?
Once institutions get comfortable holding BTC and ETH, and they see the performance contributions, they inevitably start looking for ways to generate yield within that secure framework they've established.
Make their assets work harder.
Precisely.
Wow.
And we're already starting to observe this. For example, major DeFi protocols like Aave or Uniswap, While they might not be seeing direct institutional investment in their actual governance tokens yet,
Mm.
they are seeing increased total value locked, or TVL. And that seems to be driven, in part, by growing interest in on-chain yield generation strategies, often using things like wrapped ETH or stablecoins that institutions can hold.
Interesting. So the institutional adoption of the base layer assets like Bitcoin and Ether, that acts as a powerful second wave catalyst for the more established parts of decentralized finance.
That's the thesis, yeah. The logic follows. Comfort with holding the asset leads to interest in generating returns from that asset, which leads institutions, perhaps cautiously at first, towards the more secure, audited, high-yield decentralized platforms. So they don't necessarily need to buy the native governance token of the DeFi protocol itself.
Not necessarily, no.
Yeah.
But they need the protocols to be robust, well-audited, and liquid enough for them to use safely. And that indirectly drives massive investment and development focus into those specific segments of the Web3 space.
Precisely. It creates demand for robust, secure, institutional-grade DeFi infrastructure.
Okay, let's pivot slightly to the immediate market reactions. When Morgan Stanley formally announced this 4% policy, how did the broader market respond? Did we see anything significant?
Well, the immediate reaction was definitely positive and I'd say confirming. Following the news, we saw modest but pretty healthy gains across the crypto sector overall. Bitcoin, notably, stabilized near its recent all-time highs, which seemed to signal, renewed institutional confidence.
Okay.
But that Wall Street endorsement effect, it was visible far beyond just the price of Bitcoin itself.
Which specific publicly traded companies or types of companies benefited most from that institutional blessing, so to speak?
Yeah, the crypto-adjacent stocks saw an immediate boost, which really confirms that positive correlation narrative. Companies like MicroStrategy, MSTR.
The big Bitcoin holding.
Right, which basically acts as a proxy for institutional Bitcoin exposure. Coinbase, CON, obviously, as the primary institutional gateway and custodian for many ETFs, and also the major crypto mining stocks, Marathon, MARA, Riot, RUT, they all trended higher on the news.
So it confirms the investor view that this kind of institutional adoption is like a rising tide. It benefits the entire regulated, compliant infrastructure that supports the digital asset ecosystem.
That seems to be exactly how the market read it, yes.
Now, from a psychological standpoint,
Yeah.
this consensus building around 4%, especially coming from Morgan Stanley, it feels like it changes everything for the average financial advisor talking to clients. What's the key psychological takeaway for them, do you think?
This might be the most powerful piece of the whole story, actually. The perception of risk, it seems to have fundamentally inverted.
Inverted? How so?
Well, crypto exposure is no longer being viewed primarily as this speculative, high-risk endeavor suitable only for a niche subset of aggressive clients. Instead, for many financial professionals, having zero exposure, that's rapidly starting to feel potentially irresponsible.
Wow. So not having crypto is becoming the risk.
It's transitioning towards being perceived almost as a fiduciary duty consideration within diversified portfolios. If modern portfolio theory analysis, crunched by the likes of Morgan Stanley and BlackRock, shows that a 4% allocation demonstrably enhances risk-adjusted returns over the long term, then an advisor who deliberately fails to include that allocation could be seen as demonstrably leaving potential performance on the table for their clients.
So the liability landscape is shifting. The career risk maybe is no longer in having the exposure, but potentially in lacking it.
Exactly. That's the psychological sea change happening. And this shift is actually visually quite clear when you look at the data. If you were to overlay a chart of, say, Bitcoin's price and maybe its reduced volatility against the chart of cumulative institutional ETF inflows, the correlation is becoming almost inextricable now. That influx of structured institutional money seems to be providing the stability, the buying pressure, the floor that dampens the sharp, purely retail-driven volatility cycles we saw in the past.
So this structured approach creates a fundamentally more mature market cycle overall.
It appears to be doing so, yeah.
This is the institutional money kind of smoothing out the ride, essentially.
Precisely. They're injecting liquidity at scale, ensuring smoother price discovery, building the necessary trading depth, all of which reduces the impact of individual large sales or buys. It really is market maturation being driven by professional capital.
Okay, let's look ahead then. Practically speaking, if I'm a Morgan Stanley client, maybe with a managed portfolio, what should I expect to actually see differently in my brokerage account within the next few months as this policy gets implemented on the ground?
Well, the most immediate change you'll likely see is direct, seamless access. Clients will probably start seeing Bitcoin ETFs and maybe Ethereum ETFs available directly through their standard brokerage accounts.
No more separate crypto exchange accounts needed.
Exactly. Purchasing, custody, reporting, it all becomes simple and fully integrated with their existing holdings, like stocks and bonds. It removes a major friction point.
And we discussed earlier that this 4% cap,
Mm-hmm.
it feels like just the beginning of the evolution, right? Not the end point.
Oh, absolutely. It's almost certainly just the starting point. We should expect this fixed 4% cap to quickly evolve into more sophisticated, dedicated crypto model portfolios.
Model portfolios, like prepackaged strategies.
Yeah, essentially automated investment vehicles. They'll likely feature automatic rebalancing to maintain that target allocation. And they probably won't just hold one asset, like Bitcoin. They'll likely diversify across BTC, ETH, and maybe a curated selection of other vetted, regulated crypto ETFs as they become available.
And the automation is key there.
Crucially, yes, the automation ensures the client always maintains that theoretically, mathematically optimal 4%, or whatever the target becomes, allocation, regardless of market volatility, without needing constant human intervention from the advisor or the client.
That sounds like full integration. Now, let's zoom out even further. The really long-term vision, say 5 or 10 years down the line, where does this whole path of integration ultimately lead the financial ecosystem?
Well, the ultimate long-term vision here is, I think, complete normalization. Crypto basically ceases to be classified as an alternative asset.
Just becomes an asset.
It just becomes a standard portfolio layer, treated identically to equities, bonds, or commodities within asset allocation models. Looking further out, we'll likely see the widespread integration of tokenized assets.
RWAs, real-world assets.
Exactly, RWAs, where things like fractional ownership of private real estate or stakes in private equity funds are represented by tokens on a blockchain. That could dramatically increase the liquidity of currently illiquid assets. Furthermore, those sophisticated DeFi yield strategies we talked about earlier, they could become fully integrated into professional investment models over time, allowing institutional managers to seek compliant, potentially superior yield opportunities globally, regardless of whether that yield is generated through traditional financial means or via audited, regulated, decentralized protocols.
So, in essence, it feels like the entire plumbing of Wall Street is being gradually upgraded to accommodate decentralized technology. And this 4% cap from Morgan Stanley is like the first official building permit that basically forces every other firm on the street to start their own construction projects.
That's a great analogy. That's the exact takeaway, I think. This isn't viewed as optional technology anymore by the leading players. It's increasingly seen as an essential modernization project that enhances risk management, potentially offers superior performance, and is just part of the future of finance.
Okay, well, that pretty much wraps up our deep dive into Morgan Stanley setting this formal 4% crypto standard, and crucially, aligning itself almost perfectly with the consensus already established by giants like BlackRock and Grayscale. It really does feel like the clearest signal we have ever received that crypto is transitioning, maybe has already transitioned, from an experiment into a true institutional staple.
Yeah, the structural foundation is definitely being set now, but this widespread institutional embrace, it brings with it a really powerful and I think necessary question, something for you, the listener, to consider as you digest all this information.
Okay.
Does this massive influx of traditional finance capital, while it clearly brings tremendous liquidity and much-needed regulatory legitimacy, does it ultimately help advance the core original mission of decentralization? Or does it, perhaps paradoxically, fundamentally threaten it by channeling almost all the activity through these regulated, centralized financial intermediaries like the ETFs, the major banking platforms?
That's a fantastic thought to leave people with. That tension between the benefits of institutional adoption and the core ethos of decentralization. That's probably going to define the next decade of digital finance.
It seems likely.
Now, just before we conclude today, we did want to briefly mention something. If this deep dive gave you value, if you learned something useful,
Yeah, we hope you did.
the best way you can ensure we can continue growing this show, continue bringing you this kind of quality, in-depth analysis, is simply by engaging with the content.
It sounds small, but it actually makes a big difference. We spend a significant amount of time synthesizing these often complex sources and trying to deliver the information in a clear, understandable format. Simple actions like hitting the like button if you're watching, leaving a comment with your thoughts, or subscribing to the channel, it really does help boost our visibility within the algorithms.
Yeah, your support genuinely helps us reach a wider audience of learners, people interested in this space, and lets us continue focusing our energy on bringing you the biggest, most thoroughly analyzed stories from the world of digital assets, finance, and beyond. So we truly appreciate you diving deep with us today.